So without further ado, I'm going to introduce today's featured speaker, our leader and president, Mr. Carl Frank. Carl, I've been listening to you talk for, I can't believe, nearly 15 years now, countless times. And so I feel like I've heard it all, and you never cease to surprise me, and I always look forward to it. And so this is one of my favorite Lunch and Learn events that we do all year, because it is an opportunity to kind of get into some of the nitty-gritty on what's going on around the world and questions that pop up when you're talking to your friends or you're talking to your family or coworker. This is a great platform for you to throw those questions out and see how we view things here. I'll brag a little bit about Carl, and then I'll tell you what you really need to know about Carl. So Carl's been in the business for a long time. I'll leave it at that. And back in 2009, he was the founder of Colorado Financial Planning Day. That's a pro bono event, and I think that tells you a lot about what Carl's all about. He's a guy that cares about our industry. He's a guy that cares about people. That event is an opportunity for us to work with our friendly competition, all the CFPs around the state, and be able to give free financial advice to a wide range of people. They might be homeless living on the street. They could have $1 million sitting in their checking account. But we get together and we offer up our time and make sure that they get everything squared away when it comes to their finances. Carl also served as the president of the Financial Planning Association back in 2014, and he's had various director roles, not only in that organization, but a variety of nonprofits all over the state. He's somebody we lean on here at the firm, really to spearhead our investment committee. And I think it'll be exciting to hear how he's viewing today's markets. But in my opinion, what you really need to know about Carl is he's a guy that's authentic. I think that Carl has never failed to put himself out there and be vulnerable and give you his opinion on what he thinks is going on around the world. And that's not the easiest thing to find these days. So I've always appreciated that. It's always creates a nice conversation piece and a good opportunity for everybody to feel comfortable and feel like you can trust how things are run here at our firm. So I'm going to go ahead and hand things over to Carl. Again, hold questions till the end. We'll make sure we get it all addressed and get you out here on time.
Thank you so much, Chad. That was really kind. I appreciate that. And I'm going to be vulnerable to you. What's the worst part about the economy today? The fact that we're in it. We can't get out of it. The update, talk about the markets. We'll talk about the economy, and we'll give you some of the outlook from our research partners. So we've got two different research partners, I&I Global Partners and Athena Invest. And we're going to, long story short, I'll give you the conclusion now, and then I'll give you the data between here and there. Long story short, I&I Global Partners sees opportunities in bonds, we see opportunities in equities outside the U.S., and I&I Global Partners does predict a recession. So I'll talk about that too, a mild recession. So one of our guests in the audience said, I hope there's some good news. There's a lot of good news here today, but I wanted to get lay the groundwork at the beginning here and say, well, we're starting at a rough start. So let me remind you of something. Everybody in the crowd knows this, and hopefully you folks at home know this as well, that we offer a free second opinion service for your friends and family. So please take advantage of that. Up to 3 meetings free with any one of our certified financial planners here in the office. Any one of our wealth managers would be happy to take you up on that and help your family free of charge. So keep that in mind as you go through today's presentation. And if you think of anybody, write their name down or just let us know. All right, so the market, here's a market review. Now all the slides are done through the end of September. And if you looked at your accounts in the middle of July, you would have seen that they were worth more than they were at the end of September. In fact, the S&P 500 dropped 6.3% from its intra-year high in July. Small cap stocks, smaller companies dropped 5% over that same period of time. Within foreign markets, developed stocks dropped only 4%, and then emerging markets only dropped 3% during that same period of time. So you might see some trend there that you'll continue through the rest of today's presentation. In the bond markets, 10-year Treasury climbed 0.7% over this quarter, which brought their yield up to 4.59%, which is about where it's at now. It's gone up and down since then. We'll talk about that more in a little bit, but that means the prices dropped as well. So it was a rough quarter all in all. One of the highlights during the third quarter of this year from an investment standpoint are the alternative investments. And you can see during the quarter, they eked out a modest gain, which is their job as an alternative investment in our portfolio. We want them to gain in value. One of the curious things, and I'm going to use curious as a euphemism because it's really kind of a frustrating thing for investors today, is that almost all of the returns in the US stock market are driven by 7 companies. They're called the Magnificent Seven. You may have heard that if you're paying attention to any financial news. These are the 7 companies up here on the screen. Alphabet, Amazon, Apple, Meta, Microsoft, Tesla, and a new company called NVIDIA. And between these 7 companies, they're comprising, I'll show you the next slide. I don't want to steal my surprise here from the next slide, but they comprise a huge percentage of the S&P 500, and they're up almost double year to date, where all the other 493 companies in the S&P 500 at the end of September are basically flat. In fact, through October, the rest of those companies on average would have been down. So all of the gains of the S&P 500 at the end of the September time period are due to 7 companies only. And so a basket of all the other companies that are invested might not look nearly as good as the S&P 500. This is a narrow market. A narrow market is a concentrated market. In fact, it's the most concentrated market of my lifetime. You have to go back 50 years to see a market where 1/3 of the companies that are in the S&P 500, 1/3 of the market weight is driven by only 10 companies. Back in the 1970s, early 70s, this was called the Nifty 50. Today, it's the Magnificent Seven. So it's a really concentrated market, really narrow market. All of the money over the past few months has moved into these 7 companies. And that's a tough situation for us to be patient with, because we don't want to throw our money after these big gainers, probably. We probably want to find other companies that are going to grow in the future. And that's certainly what we're doing. But, I mean, I don't know what you think. Forecasts are worth their weight, right? How many economists does it take to screw in a light bulb? None. Because the market would have already screwed in the light bulb if it needed to be screwed in, right? I'm predicting what's going to happen over the short term. Over the long term, though, concentration within the equity, a small number of equities, presents great opportunities in the rest of the companies that haven't gone up yet. All right, so here's some good news. Economic data continues to surprise on the upside. So you see 2 lines on the screen here. And the blue line are positive surprises, and the horizontal axis are years. The yellow line is inflation. So Bloomberg's Economic Surprise Index, this one on the screen here, this blue one, measures a wide array of economic data, and the news has largely been good. So the economy has generally been surprising to the upside. That's maybe not surprising in retrospect. In 2020 hindsight, you look back at this year and everybody predicted a big recession. Everybody predicted that earnings would go down. Everybody thought 2023 would be a terrible year, right? Well, the last several months has been surprising because of the resilience of the market, if not the real acceleration of companies' earnings. Despite all these widespread recession fears and despite the Federal Reserve raising rates 5.25%, the economy still looks good and it's providing upside potential. A lot of this is due to the yellow line, the sharp decline in inflation. So you can see it's actually been declining, and that's been a key driver of economic resilience, supporting consumer spending and sentiment this year. The problem is our researcher doubts whether that's going to continue. So they're a little bit more pessimistic. In fact, they predict, IM Global Partners, our chief research partner, predicts a mild recession maybe near the beginning of next year. And there are many indicators that support a recession outlook. The one you see on the screen here is from the New York Fed, and that's their prediction of the possibility of a recession. And they're giving it basically a 2 in 3 chance that there will be a recession here in the future, according to the New York Fed. But there's many other indicators as well. The yield curve is one that we often hear about, and the yield curve most recently flattened out, but today is again inverted. What that means is that investors as a whole, all of the professionals out there, are thinking that interest rates will be lower in the future. The only way that happens is if the Federal Reserve lowers rates in order to try and spur economic recovery. Well, that is implying that there may be a recession in the future. Tighter monetary policy is impacting the home industry. We were talking about that earlier. It's tough to be a home seller. It's certainly tough to be a commercial market, a commercial realtor. Right now, I would imagine the realtors are struggling. Certainly commercial real estate is becoming more and more empty, the trend that we're in right now. And then, of course, banks are tightening lending. And the slides I saw this morning before presenting for today show that lending has been tightening at an increasing rate, which means it's going to get tougher and tougher for banks to lend money to anybody who wants to buy real estate, but also to companies who want to borrow money in order to build their companies. And so these are all indicators that the economy might be slowing here in the future. Now, while INGP anticipates a recession, the base case is that it'll be relatively mild, partly because many companies and investors have been anticipating this for a long time. We used to joke that this is the most anticipated recession in history. Well, that could be the case. I don't know whether we ever anticipated one more than this, but this one, people have been looking and thinking badly for a very long time. I think we're still in the wake of a pandemic, kind of comatose period of time. Amid the buildup, companies, of course, thinking about, planning about recession, they've had plenty of time to do this, are building up their cash reserves. Tech companies have been laying people off or at least slowing down the hiring. All of these things make the recession more mild because it's been spread out over a longer period of time. So for these reasons and many others, again, our research partner at IMGP thinks it'll be a mild recession, which is really good news from a stock investor, right? I mean, which person in the Bible would have been the best investor? Noah, right? He was still afloat. His stocks were still afloat while everybody else is underwater. Well, we've been there for a long time, right? We just like Noah, right? We've got our stocks already there. They're not underwater. They're large, by and large, very profitable companies with very low amounts of debt. And it's just a matter of time before the water catches up to them. The next slide is huge. So I'm going to spend a little time on that. There's a lot of data on this, and it's really an easy slide to understand. But what it's attempting to do is explain probably the single biggest indicator or reason for the economic malaise over the recent past. So what you see on here are two tables. Just pay attention to the table on your left first. And what you see there is a series of rows. And every row is a different period of time. And if you could read the numbers, I don't know if you can, but they're basically different years. And what that's telling you is the month in which the Federal Reserve stopped raising rates. And so that happened over a certain period of time, and it's going back to the 1950s. 1953 is the first indicator. So you get 70 years of history. And then the two columns beside it are how the S&P 500 did 6 months after the Federal Reserve stopped raising rates and 12 months after the Federal Reserve stopped raising rates. And if you don't see anything else, you can see the colors. A long time ago, the S&P 500 12 months afterwards didn't do as well. There's more red color in the past than there is in the very recent past. After the Fed is done raising rates in the recent past, within 6 months to 12 months, the S&P 500 has done a lot better. And in large part, the stronger correlation isn't that we weren't as good at it 70 years ago as we are today, but inflation expectations. And a long time ago, that's 70 years ago, we had higher inflation. And so what the Federal Reserve had to do was keep those rates higher for longer, and it slowed the recovery. More recently, when we've had lower inflation expectations, the Fed was able to re-inject some surplus or re-inject some stimulus into the market. And so that's what the other chart is showing. The chart on the right-hand side is showing how many months it was after the last Fed increase before the Fed actually reversed course and reduced interest rates, which of course is a stimulant for our economic situation that we're in, all the companies that we're invested in. In any event, if you look at the bottom line, on average, you've got a pretty good rate of return within a year after the Fed's done raising rates. And it looks like about 9 months after they raise rates, they'll actually start to lower rates. So this all leads into IM Global Partners' predictions that if we're done raising rates, and we think we are, the Federal Reserve has by and large said, we're probably not going to raise rates again. And then maybe 9 months from now, the middle of next year, maybe by then we will have started a recession or been feeling a little bit of pain, and so the Fed's going to start to stimulate again next year. And that, all this data is subject to change. All this is just historical stuff, right? I mean, did you hear about the economist who got hurt by jumping into an empty swimming pool? He didn't seasonally adjust. Right? I mean, there's no... economic jokes.
You're a dad, that's right.
I'm a dad. I got a lot more dad jokes in my drawer, right? I mean, there's no real method here other than best guesses. Historical history is our best guide, and it's the best guide we have, but it's not a reliable predictor. If it were a predictor and we could all rely upon it, then that would break and everybody would go and invest in that way, right? So It looks like we're facing a mild recession, according to these guys. It's not going to be that bad. We've already been preparing for it for a long time. Companies certainly have been preparing for it. There's been more and more news and their announcements about we've got softening demand. We're worried about that. We're not going to increase our hiring. We've already taken steps to reduce our debt or fix it. All of these things are going on. In fact, S&P profits came into this year expecting a huge decline in the profits of the companies in which we were invested, some of the best companies in the world. In 2022, they declined 13% year over year. And in 2023, many of the consensus forecasts were that it would decline even further. Well, they didn't. They didn't. In fact, they look like they're troughing. At the end of the year, you can see the profits. When this line is below the horizontal line, that means they're declining. When the line is above the horizontal line, that means they're increasing. And it looks like they're done going down, that the profits may be heading back up. And that would obviously be very good for all of us equity investors. Should the current consensus numbers for the third quarter be accurate, earnings will be flat year over year. In fact, I&I Global Partners think they might rise in the fourth quarter and be up year over year. Now, how do you confuse an economic forecaster? You ask them to explain the real world. So this is not going to happen. But this is their best guess, right? This is their best guess. All right, so where are we going to invest? Well, like we were talking about, if you didn't already have a whole bunch of money in the Magnificent Seven stocks, and you're in one of our portfolios, you probably would have diversified out of that already, right? And these are all probabilities. Talk to your financial advisor about your unique situation. But you probably would have been putting money into countries outside of the U.S. And here's one of the major reasons why. On the horizontal axis, you'll see years, and the years go back pretty far, 2006, so call it almost 20 years ago. And then each of the colored lines are one of the areas of the world you could invest in. The U.S. domestic market is that blue line, the darkish one. The yellow one is the developed world, and the grayish one is the emerging market world. So these are the countries in the world that are growing faster, but they're smaller economies right now. Look how a long time ago, the price per earnings, the value, the price that you'd pay for every unit of earnings in a stock were about the same. And they stayed the same for a little while, but very recently they started to diverge. And what that means is that Americans are willing to spend a whole lot more money to buy a U.S. company when they could buy a foreign company with the same amount of earnings for a whole lot less. It's a little bit like choosing to shop at the expensive mall in Cherry Creek when you could go to the discount mall in Castle Rock and get the same item, but you're choosing to pay a lot more up there. And that's what Americans have been doing for a while. Well, the valuations eventually will probably come back together. That's what I&I Global Partners is predicting. And what that means is that the prices of the foreign companies have to go up. So they're hopeful, and we are too, quite frankly, investing alongside you, that that is the case, and that the countries outside the U.S. with the companies that are there will start to become more on par with the companies in the U.S. because you can't have that Magnificent Seven like we did, where the PE ratios are outside the roof forever. So foreign stocks look very appealing. Another thing that looks very good for investing outside the U.S. is a weaker dollar. So what this chart is showing is the dollar relative to other currencies in the world. Again, on the horizontal axis, you'll see years, and this one goes back pretty far. This goes back to 1971, so more than 50 years. When the line is going down, that means the dollar is declining in value. So back in 1971, Bretton Woods happened, and the dollar lost value relative to a lot of currencies in the world. It then rose really quickly in the 80s. And during that period of time, lots of things are happening in the United States. Then the dollar declined. It's never been as strong as it was in the middle of the 80s, but it's been going up and down since then. The color of the chart is counterintuitive, perhaps. When the line is yellow, what that means is that U.S. companies are doing better than foreign companies. So as the dollar is strengthening, U.S. companies do better than the foreign countries, right? As the line turns blue, it means U.S. companies are doing worse than foreign countries. So take, for example, the most recent period of time, this little blue line, and now we're in a yellow line. In the beginning of this century, this millennia, we had a period in the U.S., period of time we called the 2000 to roughly 2010. People were calling it back then, this was the bad economy back then. There's always bad news about the economy, right? Back then it was the lost decade. And the S&P 500 over that period of time, according to this, it still returned 38%. But foreign companies returned 104%. So having a little bit overseas and a little bit in the US really pays off in a period of time, especially when the dollar is declining. And most recently, I think a lot of Americans and certainly a lot of economists, the consensus concern is that the dollar might decline. Right? We've issued a huge amount of debt. We've got a big burden to pay. And so relative to other currencies, the dollar might be overvalued right now and may be declining. Well, this would be good for investing foreign, and you want to be there before it starts to decline so that you can catch that train when it's leaving the station. So that's another reason to be a little bit more confident in having not all of your money in S&P 500. Now, another good news for retirees is that bonds are beautiful. I haven't said that in my entire career. In my entire career, I've been saying there is no alternative, right? You basically have to be in equities. But this has suddenly changed according to A&I, and I don't know that you will catch me saying that outside this presentation ever again. But in this chart here, the yellow line is showing you the divisor. And what that means is that above that, stocks are more attractive to bonds, and below that, bonds are more attractive to stocks. And again, this is the horizontal axis is years, and this goes back to 1976, so almost 50 years. And it hasn't been this way in a very, very long time. But what has happened is that finally interest rates have risen 5.25%. And now you've got a pretty stable set of income that you can get. So as a retiree, this is a pretty nice place to be. You don't have to, if you don't want to, depend on equities for all of it. You can now get some from a more stable place. We're going to go into, we have already accomplished 2 years in a row of a negative total return for bonds. And 2023 may end up to be the 3rd year in a row, which would be the first time in history that's ever happened. Last year was the worst time since the founding of the United States of America that the bonds did as bad as they did. So we're really in a period of time where, if you think about it, all the bad stuff's behind us probably, right? We've just gone through the worst possible time to be that type of an investor. So maybe now is a great time to talk to your financial advisor about whether you want to consider it. Or maybe not. For all the reasons I just talked about, equities could be absolutely where you want to be, because all the companies that we're talking about outside of the Magnificent Seven haven't realized those great gains. You could be looking at a really bright future. It could be a really good time to be a patient investor. Here's the bond yields for some of the investments that you might see in your portfolio right now. That's a list of them as of September 30th. The blue line is what it was. The other 2 lines that you see is where they were a year or 2 ago. It's never been better, is the bottom line. Right? The blue line is huge. So the yield, the income that you're getting from your fixed income investment, never been better, at least recently better than it is right now. So this is a pretty good time to be a patient investor, right? It's a little bit like the opposite of being a Bitcoin investor. Be very, very patient. All right, so that's the IM Global Partners forecast. We don't just depend on any one investment forecaster. We believe in a diversity of opinions. We believe the right way to invest is to invest in different ways. Hold them accountable to the way they're investing and be a little humble. And then just check in and make sure that things are doing what they said they would do. And that's our job. And we talk to these people every single week, and sometimes more than a week. We'll go to an investment conference beginning tomorrow with one of our investment companies and do some on-site due diligence and make sure that we're comfortable with some of the questions we have and the answers they give us. So our other big research partner is called Athena Invest. Now they're in Colorado. They're not IM Global Partners, a huge international company. Athena is a small local firm, and some of you have heard the professor speak at various events. And they summarize everything with quantitative analysis. They just do the math. And they give us this nice barometer. You can go to their website, athena.com, and see the exact same thing I'm showing here anytime you want. And divide it into 4 categories. And the first category is called behavioral, and that's where Dr. Howard got his patent, is in the behavioral analysis portion. It's very different from any other analyst out there. It's one of the reasons why we got really intrigued with Dr. Howard. And the behavioral market indicator says things are largely green and maybe a little bit of caution, but they like U.S. companies, they like U.S. small companies, which makes a lot of sense if you think about it, because these mega caps are already really expensive. We talked about the Magnificent Seven. So they're viewing behaviorally, this is a good place to be. We want to be in the smaller American companies, according to Athena. The second category is economic. Now the PhDs at that company, they believe in academic research. And so there's two academically proven economic forecast. Everybody has access to these two. One measures good, one measures services, but they have a little bit of predictive power driven by statistics. And goods and services activity are normal. So if you didn't pay any attention to the news and you didn't look at your account, you didn't know about the wars and all the other things that are going on in the world, you just say this is normal. Absolutely normal of looking at goods and services, two huge parts of our economy. Third one is valuation, and they're saying it's normal. So this is important because a lot of us hear on the news that stocks are expensive. But the big differentiator that we don't always pay attention to, if you're a person who pays attention to financial news, is look at whether it's forward earnings or the earnings that have already happened. And looking at forward earnings like Athena does, earnings are right in alignment, right? You've got a few high-tech companies that are crazy expensive, NVIDIA, among Tesla and all these others that I mentioned before. But most of the US companies are just normal. This is right in range. No big deal. And the final category they look at is technical analysis. And they're just saying, things are yellow or green, quite frankly. I mean, things look pretty good. So all in all, just bearing it down into a little dashboard you can look at any time is not bad. It's a good time to be a patient, long-term investor, according to them. Economics, it's not really funny, right? Except to anybody who's actually studying it. And then you're like, oh my gosh, this is ridiculous. So give yourself a break. If you look at this and you think it's a little overwhelming, and you wouldn't be alone. And the closer you look, and I'd love to talk with you about any of the details, it may be more and more ridiculous because there is no predictive power. I don't know that anybody came into last year predicting bonds would do what they did. I don't think anybody came into this year thinking that all of the returns of the most commonly quoted measure of the U.S. stock market called the S&P 500 would be delivered by 7 companies who nearly doubled their stock price on average, while all of the other 493 would be basically flat, with a whole lot of dispersion in there. That actually, the dispersion is a huge opportunity that our research is a great time to be an active stock picker, because eventually the money will move out of that the fear play of the mega tech companies into the investments that are producing positive cash flow, profitable, and diverse in the ways that we. So the bottom line, the conclusion is that international equities, they see opportunities, bonds, finally, perhaps there's opportunities, and they predict a mild recession. But we've been predicting it for such a long time that it's not going to be a big deal, according to me. Now, we'll do this again in February, right? We do this at the end of every quarter, and then it takes a couple of weeks for them to prepare the slides. It takes us a couple of weeks to get it through our compliance officer. So it'll be February, and it'll be just like this was the September data, and I'm presenting it to you at the beginning of November. It'll be February for that, and we'll see how right they were for the end of the year. Generally speaking, the end of the year is a great time to be there. Talk to your advisor. Probably want to hang in there, but make sure that your investments are involved. And that's my prepared.
Perfect. Well, look.